Understanding the differences between resistance and support for successful crypto trading. Understanding support and resistance principles will help you enhance your crypto trading performance. Support and resistance are the most commonly used levels in trading and are the bread and butter of technical analysis. It would be difficult to develop a profitable trading strategy without understanding how support and resistance work. Buying at support, low price, and selling at resistance, high price, is a fundamental trading theory that requires understanding of the two ideas in order to trade profitably. What effect do support and resistance have on your trades? Continue listening to learn more. What exactly is support? A price level at which a bearish trend is likely to be temporarily obstructed or completely reversed is referred to as support. Buyers trying to buy a crypto token at a lower price when it is undervalued set the level. Assume purchasers purchase Bitcoin, BTC, at price X, causing the price of BTC to rise. They will attempt to maintain their position at price X and perhaps add to their positions whenever the price returns to the X level. Buyers will see such a point as a safe level to add more purchase pressure because they were able to boost the price of BTC in the first instance that it could not fall below price X. The buying pressure keeps the price from falling any further, forming a temporary barrier known as support. What exactly is resistance? A price level at which an uptrend or bullish move is projected to revert or have a temporary barrier is referred to as resistance. The resistance level is usually where there are a lot of sell orders. When an asset becomes overpriced, sellers attempt to profit from it. Buyers would also begin to hunt for opportunities to exit their positions and pocket their profits. Some of them may even take a sell position at the current price level. The selling pressure, like the buying pressure, in the case of support, produces a barrier known as resistance. Price normally follows support and resistance levels until they are broken. Lines have traditionally been used to signify support and resistance levels, even though these levels are not accurate in real-life situations. Support and resistance should be viewed as zones or areas rather than lines. They are more akin to a price range in a chart that works as a wall. Recognizing support and resistance. There are numerous methods for determining support and resistance levels on a cryptocurrency price chart. These methods can be divided into two categories: psychological resistance and support levels that we generate by how we think, and trading indicators that have been developed to recognize them. We will look at this psychological element quickly, as well as how two of the many technical indications identify support and resistance. Numbers that are rounded, psychological support and resistance. Round numbers are commonly used as resistance and support since prices find it difficult to move past them. They are frequently referred to as psychological support and resistance zones because they do not always correspond to any technical pattern on the chart. They are in our heads. Many of us prefer to pay round rates like $35 and $50 rather than $34.67 or 49.26. This preference prompts us to place orders in whole numbers. More orders at these points generate pricing barriers. If a large number of purchasers execute a buy order at, say, $50 when the price of a crypto token is sliding towards $50, such orders could act as a support wall at that level. Because the major players in the forex and stock markets, huge banks, large corporations, and financial institutions, also deal in round numbers, these points are extremely essential in these markets. Trendline. In trending markets, a trendline is especially important. It finds areas of support and opposition that are related to them. The price keeps bouncing off the trend line, which represents the resistance levels, presenting a selling opportunity at each time. Traders would just need to look for other confirmations before placing their orders. The moving average. A moving average is a popular indicator used by traders to identify support and resistance. It functions as price support or resistance. A moving average can also be used to identify trend reversals or pivot points on a chart. In an example chart, the price bounced off the moving average at several points. In this scenario, it aids in identifying critical resistance levels. Additional indicators. Many more indications aid in identifying critical levels on the cryptocurrency price chart. Many traders examine 4 important points when using the Relative Strength Index, RSI, for example. Positions that have been oversold, below RSI 30. It's a seller's market, RSI 50 to 30. Buyer's market, RSI 50 to 70. The position is oversold, RSI 70 to 100. On their own, these levels provide resistance and support. You could use other technical indicators, line tools, price actions, and a variety of other tools to discover these significant price levels. You just need to figure out which one works best for you. How to trade resistance and support. There are numerous strategies for trading support and resistance. In actuality, if you ask 20 traders how they trade support and resistance, you may receive 20 different responses. 2 things may be shared by the majority of them, forming the key things people do near support and resistance. Traders may place trades following a bounce or a breakout. These 2 ideas will be discussed further. Following a bounce. One of the most common methods of trading with resistance and support is to wait for a price bounce before placing an order. Because there is a risk that the price will reverse, you may want to wait for the reversal and then look for confirmation before entering the trade. Why should you wait for a confirmation? A confirmation is required because not every support or opposition is consistent. Before taking any stance, we should check to see if the chances are in our favor. We don't want to assume that the price will automatically rebound off our support or resistance level, but we do want to see it bounce off and provide us with some further information before going into a trade. Following a breakout. Support and resistance levels do not always hold, they frequently break. As traders begin to anticipate trading at the new price zones, such a breakout creates trading chances. At this point, all we can do is wait for confirmation that the price has broken through the points, and then try to find an entry when we get more confirmations. When a price breakout occurs, there may be a pullback before the price continues to move. For example, when support is broken, there is a chance of a pullback, which some traders refer to as a retest. The pullback causes the price to retrace back to the previous broken support, which would have become a resistance, before restarting its upward movement. To execute a trade, we may wait for a downturn and then check for confirmation to enter. Some traders will also enter headlong shortly after a breakout, which is a more aggressive strategy. In an uptrend, old price resistance zones that have been broken become the support from which the price may retrace. In a downtrend, the converse is true, the broken support acts as resistance, which is expected to hold the price. Understanding support and opposition isn't enough. Technical analysis is built on the foundations of support and resistance. They are incorporated into the majority of trading techniques. These levels can be respected or broken by price. Because the price does not always respect support and resistance levels, you must use adequate risk management tactics to reduce losses when a transaction does not go your way. Identifying support and resistance on its own does not guarantee trading success. It is a necessary skill for each trader to have. There are other trading ideas to master, such as price action, risk management, and trading psychology. Before starting a trade, you should also study other confirmation tactics to use in conjunction with support and resistance. You should only make trading decisions after determining the market direction with a variety of instruments, rather than depending solely on one tool. If you don't have the time to learn or master trading, you might hire a trading robot to do it for you. This procedure does not necessitate any analysis.